What's up, future Filipino CPAs? Welcome to your official study hack for the LECPA. You know how you look at some things and you're just like, what even is that? Well, in accounting, we have those too. Today, we're cracking the code on one of the trickiest topics you'll face, compound financial instruments. Let's get into it.
So, picture this. A company issues a financial instrument, and you're sitting there, trying to figure it out for your exam. Is it debt, like a loan the company has to pay back? Or is it equity, like a piece of ownership in the company? The tricky part is, what if it's both?
And that's exactly what a compound financial instrument is. It's a single financial instrument, just one contract, but from the company's point of view, it's actually packed with two separate things, a liability part and an equity part. It's a hybrid, all rolled into one.
Now, in the Philippines, and especially for your LECPA, you're going to see two main types of these. First, you've got convertible bonds. These are basically bonds that the holder can later swap for a certain number of the company's shares. Then, you have bonds payable issued with share warrants. Think of this as getting a bond plus a little bonus ticket or an option to buy shares at a later date for a pre-agreed price.
Okay, here's the brain hack to make this stick forever. Seriously, think of it like a fast food combo meal. You pay one single price for the whole thing, right? But you're getting two distinct items. Your burger, which is like the debt component, and your drink, which is the equity option. One price, two separate things. You have to account for both.
So, we know we have to split our combo meal, but how do we do it? And why? For that, we turn to the official rulebook, Philippine Accounting Standard 32, or PAS 32. And this standard drills down on one of the most fundamental ideas in all of accounting, substance over form.
And this quote right here is the heart of it all. PAS 32 basically says, I don't care what you call it. Look at what it actually is. It's all about the economic reality, the substance. So even if the paper says bond, if it acts like a bond and an equity option, you absolutely have to treat them as two separate pieces.
All right, we get the why, now let's get to the how. This is the part you really need for your exam. It's a super straightforward process called the residual method. And trust me, this is your key to getting these questions right every single time.
And here it is, the golden formula. It's literally just subtraction. You take the total money the company got for the instrument. That's the issue price. Then you subtract the fair value of just the liability part, and whatever's left over, the residual, well, that's the value of your equity component. Simple as that.
Let's break it down. 4 easy steps. Step 1, find out how much cash the company received in total. Step 2, and this is the crucial one, figure out how much the liability part would be worth by itself, as if there was no equity feature attached. Step 3, you subtract that liability value from the total cash. And step 4, boom, what's left over is your equity component. Always remember, liability gets valued first, equity gets what's left.
Okay, cool, but you know the exam is going to throw a curveball, right? They love to ask about the little details. So what about transaction costs? The fees for lawyers, bankers, all that stuff. How do we handle those?
The rule here is actually super logical. You just split the costs fairly. The transaction costs get allocated between the liability part and the equity part based on the values you just calculated. So if your split ended up being, say, 90% liability and 10% equity, then the costs get split 90-10 too. It just makes sense.
All right, let's put it all together in one final brain hack. This is the slide to screenshot, the one to burn into your memory. This is going to help you remember this stuff not just for a quiz next week, but for the actual board exam in a few years. Let's lock it in.
Here's your cheat sheet. What are we talking about? A hybrid instrument. What's the main rule from PAS 32? Substance over form, which means you must split it. How do you split it? With the residual method. Value the liability first, equity gets the rest. And what's that final detail? Proportional allocation. You have to allocate those transaction costs based on the values you found. Got it? Good.
So there you have it. You've totally cracked the code on splitting these compound instruments, which leads me to one last question for you to think about. Now that you get this core principle of substance over form, what other areas in accounting can you think of where we have to look past the name on the contract and focus on what's really going on? Keep that mindset and you're well on your way to becoming an amazing CPA. You got this.